complex contracts, and hidden exclusions. Insurance policies are often dense legal mazes written at high reading levels. This design exploits the no understanding problem. Insurers can legally disclose everything, but arrange the text so most customers won't grasp the full picture. A benefit promised on page 1 can be nullified by an exclusion on page 6. During the pandemic, many businesses found their business interruption cover required direct physical damage, or had virus exclusions they'd never noticed. Insurers denied claims, and courts often sided with the contract wording. This works through deliberate contract architecture. Key exclusions are placed far from coverage grants, so you feel reassured early and are blindsided later. Condition stacking adds complex duties after a loss, where one missed step can void a claim. Finally, definitional traps redefine everyday words like flood or accident in the glossary to be much narrower than common usage. It's a strategy of being technically disclosed, but strategically confusing, allowing insurers to collect premiums on broad-sounding promises while paying out on narrow, glossary-bounded realities. Claim delays and denial tactics. Once a claim is filed, the insurer's goal is to minimize the payout. This begins with procedural delays, such as asking for documentation in small, sequential batches so the clock keeps resetting. Deadlines are rigid for the claimant, but elastic for the company. Denials follow predictable patterns. The non-disclosure defense allows an insurer to void an entire policy over a minor, irrelevant detail omitted from the application. Causation parsing is used to reclassify the loss to fit an exclusion, such as arguing a roof collapse was due to wear and tear rather than storm damage. This strategy functions as attrition. Many claimants, exhausted by the ordeal, settle for reduced payouts. In auto insurance, this is known as delay, deny, defend, where low-value claims are dragged out until the customer accepts a low-ball offer. Health insurers use similar pre-authorization hurdles to delay or deny treatments. The goal is to make the process so arduous that many policyholders give up. Premium manipulation and algorithmic discrimination. Modern insurance pricing is a behavioral experiment run by algorithms. Using personal data from credit scores to online purchases, companies use price optimization to predict who is likely to shop around and who will stay loyal. Two people with identical risk profiles can pay different premiums simply because one is predicted to have a higher tolerance for being overcharged. Health and life insurers use predictive underwriting, examining lifestyle proxies like zip code health averages or pharmacy purchases to estimate future medical costs. The outcome is stratification. Those in low-income areas face higher rates, even if personally healthy. Because the models are proprietary, the bias is invisible. This is deepened by loyalty penalties. Insurers lure new customers with teaser rates, then algorithmically detect when they stop comparing prices and quietly raise premiums over several years. In 2021, the UK's regulator banned this practice after finding long-term policyholders paid significantly more than new ones for identical coverage. Underinsurance and the shifting of risk. Back to you. Insurers offer policies that sound comprehensive, but quietly transfer the financial burden back to the customer. The most common form is underinsurance, where coverage limits fall short of actual costs. Consumers are often guided to save by declaring conservative asset values. When a loss occurs, payouts are reduced by the average clause. If you insure your home for 70% of its rebuild cost, you'll only get 70% of any claim, even for partial damage. This mechanism isn't accidental. Insurers collect full premiums on policies that will rarely pay out fully. This risk shifting is layered with deductibles and sublimits. A health policy might show a generous total coverage amount, but then cap hospital room rates or specialist visits to a fraction of that sum. Commercial policies often require co-insurance, meaning the client must self-fund a percentage of every loss. This creates a protection gap. where the nominal insurance in an economy far exceeds what would actually be paid out. Denial by design, bureaucratic loops, and psychological fatigue. Insurers know that exhaustion is cheaper than confrontation. Instead of an outright denial, they build procedural labyrinths designed to make customers abandon their claims. This is achieved through layered requests for documents, constantly changing contact agents, and vague communications that reset the process, buying the company time. The system's strength lies in asymmetry. The insurer's staff know the rules and deadlines. The customer doesn't. A missed 30-day notification can nullify coverage, regardless of the loss's legitimacy. The company doesn't have to say no, it only needs to let the clock run out. Psychologically, this tactic leverages the stress of a crisis. People who have just experienced an accident, illness, or death are least capable of sustained bureaucratic navigation. Internal documents call this attrition management, the art of reducing claim persistence through procedural friction. The claimant's exhaustion becomes the insurer's profit. Health coverage, exclusions, and the mirage of care. Health insurance relies on the illusion that coverage equals access. In reality, exclusion lists and reimbursement caps hollow out the promise. A policy may cover hospitalization, but exclude intensive care or specialist consultations. In the US, a patient with an in-network surgeon but an out-of-network anesthesiologist can face a surprise bill for thousands. Mental health care sits at the sharpest edge of this. Insurers often use medical necessity reviews to deny therapy beyond an arbitrary session limit, or classify mental health as pre-existing or non-essential. This architecture magnifies inequality. High-income clients buy comprehensive packages that waive exclusions, while others navigate fragmented plans where insurers reimburse selectively or require prepayment. Health insurance thus becomes an access-gating mechanism, filtering who gets timely treatment and who delays care to avoid debt. The policyholder technically has insurance, but in the moment of need, coverage transforms into a negotiation. Exploiting fear through aggressive marketing and emotional targeting. Insurance is sold not through logic, but through fear. Advertising relies on psychological triggers, the threat of loss, the promise of security, and the moral weight of responsibility. Campaigns are designed to shift perception from optional protection to moral obligation. You're not just buying coverage, you're being a good parent or a prudent adult. These tactics are precision engineered. Life insurers target new parents and newlyweds, timing messages to life events scraped from data brokers. Health insurers focus on aging populations using imagery of frailty. Product names like Freedom Protect or Secure Future function as emotional anchors that equate purchase with virtue. Once the fear is embedded, cross-selling takes over. Existing policyholders are steered toward add-ons like critical illness riders, many of which duplicate existing protection but increase recurring premiums. In digital markets, recommendation engines automate this, using search histories to trigger urgent insurance prompts. The entire funnel turns emotion into margin. Policy lapses and the fine art of forgetting. Insurers profit immensely from lapses, contracts that end because the policyholder missed a renewal or payment. The company keeps every premium collected up to that point and owes nothing further. Many lapses occur not through active choice, but through confusion. Renewal notices sent to old addresses, failed automatic debits, or billing system changes. Some insurers exploit this. Agents may be incentivized to oversell complex policies to first-time buyers, knowing many won't maintain payments long enough to reach maturity. This is especially severe in long-term investment-linked policies. These products front-load costs and commissions in the first few years. If the policy lapses early, the customer forfeits nearly all accumulated value, while the insurer and agent have already pocketed their share. The industry's quiet success lies not just in claim fulfillment, but in ensuring many policies never reach the claim stage at all. reinsurance, and the invisible layer of detachment. Behind every insurer sits a reinsurer, a global corporation that insures the insurers themselves, absorbing catastrophic losses. While this stabilizes the system, it also creates moral distance. The primary insurer becomes more focused on managing compliance than on the human side of loss recovery, as another company bears the ultimate financial burden. This detachment changes incentives. When disasters strike, the reinsurer's contract, the treaty, dictates what is payable. This can lead to cascading denial. Your insurer may delay payment while negotiating reimbursement from its reinsurer. The customer becomes collateral in a dispute between corporations. Reinsurance also amplifies global inequality. Rich markets, backed by global reinsurers, recover quickly. Poorer nations, deemed high risk, struggle to attract reinsurance at affordable rates. That scarcity leads to higher premiums, narrower coverage, or total withdrawal of insurers from vulnerable zones. It's an invisible sorting system where global capital quietly decides who deserves protection. Government capture and regulatory theatre. While insurance is heavily regulated on paper, regulatory capture is common. Oversight bodies are often influenced or funded by the corporations they police. Many national insurance commissions rely on fees from industry licensing and compliance filings to fund their operations, making aggressive enforcement financially inconvenient. The most visible sign of capture is theatre regulation, frequent announcements of consumer protection initiatives that rarely translate into penalties. Governments create non-binding ombuds offices or dispute resolution bodies that issue recommendations, not enforceable rulings. The illusion of accountability replaces real change. At the global level, industry lobbying power shapes entire legal frameworks. In the US, state insurance commissioners' campaigns are often funded by industry donors. In the EU, complex regimes like Solvency II entrenched large players by setting compliance costs too high for smaller competitors. When rules are written by those they regulate, protections are often decorative. Investment exploitation and the use of your premiums as capital. Your insurance premium doesn't sit in a vault. It's immediately converted into investment capital. Insurers operate as massive institutional investors, controlling trillions in assets. They invest this float, money collected today for claims that may never come, in bonds, equities, and real estate. This structure creates two major conflicts. First, premiums are often funneled into industries that contradict customers' interests, such as fossil fuels, tobacco, or private prisons, because they generate high returns. The average policyholder never sees where their money goes. Second, the investment motive skews claims behaviour. During economic downturns, when market losses shrink portfolio values, insurers tighten claim approvals to preserve liquidity. Regulators noted spikes in claim rejections during the 2008 and COVID-19 crises, suggesting financial pressure directly shaped payout decisions. You aren't just insured by a company, you're underwriting its investments. The exit trap, cancellation barriers, and loyalty penalties. Getting into an insurance policy is quick, but getting out often involves retention friction. Barriers that make cancellation slow and confusing. Online portals may lack a cancel button, forcing customers to call a service line where representatives use fear-based talking points to save the policy. Auto-renewal systems deepen the trap. Insurers legally default customers into renewals unless they opt out before a specific deadline. Miss the window, and the policy renews automatically. Loyalty itself becomes a liability. Insurers track renewal history to flag stickiness, which algorithms interpret as a willingness to tolerate rising costs. Each renewal becomes an opportunity to quietly increase premiums. The UK's 2021 loyalty penalty investigation found that some households were paying 70% more than new buyers for identical coverage simply because they hadn't switched. This is an algorithmic punishment for trust.